The silver market is entering a phase defined less by stability and more by tension. Recent price action has placed the metal in a narrow zone where momentum is building, but direction has not yet been fully resolved. Market participants are increasingly focused on the possibility that silver may soon approach the $100 level, not as a distant projection, but as a near-term outcome shaped by current conditions. This expectation is not being driven by a single event. It is emerging from a combination of forces acting on the market simultaneously. Price behavior has become more erratic, with rapid movements followed by periods of consolidation. These fluctuations reflect a market attempting to balance strong upward pressure against short-term constraints that have not yet been fully absorbed. Volatility has therefore become a defining feature of the current environment. Instead of smooth, linear advances, silver is experiencing sharp reactions to new information, shifts in positioning, and changes in trading dynamics. Each movement is closely watched because small adjustments are now capable of producing disproportionately large effects on price. Within this context, the idea of $100 silver has shifted from a theoretical benchmark to a practical one. It represents not only a psychological level, but also a measure of how far the current bull cycle may extend if existing dynamics persist. At the same time, there is growing recognition that this advance is unlikely to be uninterrupted. Market structure suggests that periods of pullback and hesitation are part of the process. These movements do not necessarily indicate weakness, but rather the internal adjustments that occur as the market transitions between phases of acceleration. What is clear is that silver is operating within a framework of elevated uncertainty. Price action is being shaped by multiple overlapping influences, whose interaction creates conditions that are simultaneously supportive of higher prices and prone to short-term instability. For this reason, the current environment is not defined by a single price target. It is a market actively re-rating itself in response to shifting pressures. Understanding this context is essential because the path toward $100, if it materializes, will likely be marked by significant fluctuations before any sustained level is achieved. Recent silver behavior cannot be understood solely through the lens of financial markets. At present, the metal is being directly influenced by broader changes in the geopolitical and trade environment. These changes are altering how capital moves between regions and how prices are formed in international markets. One of the most relevant factors is the gradual shift of activity from Eastern to Western markets. This process does not occur abruptly, but through progressive adjustments in trade and financial flows. As these flows are reconfigured, silver is affected by new supply-demand dynamics that were not present in earlier phases. Added to this are announcements related to the imposition of U.S. tariffs on several European countries. These measures introduce additional friction into international trade, increasing costs and complexity in cross-border transactions. For metals markets, this translates into greater uncertainty regarding future prices and a reassessment of associated risks. The combination of these factors creates an environment in which silver ceases to be only a financial asset and becomes a reflection of structural tensions between economies. Each shift in trade policy has the potential to alter market expectations, and those expectations are rapidly incorporated into price. As a result, recent movements are not random. They are linked to a deeper transformation in the framework in which global trade operates. Silver, positioned at the intersection of investment and industrial use, becomes a sensitive indicator of these transformations. This geopolitical and tariff-driven context does not guarantee a linear trajectory. However, it does establish a foundation in which upward momentum can intensify, even as short-term corrections occur. The strength of silver prices is not dependent solely on financial or speculative factors. There is structural support stemming from its role as an industrial input and, simultaneously, as an inflation hedge. This dual nature creates a base of demand that tends to persist even in highly uncertain environments. From an industrial perspective, silver remains an essential component in multiple production processes. This ongoing use generates demand that is not directly tied to financial market behavior, but to operational needs that endure over time. Physical consumption therefore contributes to stabilizing the market during periods of volatility. In parallel, silver retains its appeal as a store of value in a context where inflation remains present. As the purchasing power of currencies erodes, investors seek assets capable of preserving real value. In this setting, silver positions itself as an accessible alternative with a long history of monetary protection. The interaction between these two forces reinforces the upward trend. Industrial demand provides a steady foundation, while inflation hedge demand amplifies movements when perceptions of economic risk increase. The result is a market in which pullbacks tend to find support relatively quickly. This balance does not eliminate volatility, but it does help ensure that corrections are more often interpreted as adjustments within a trend rather than structural shifts in direction. Silver, therefore, continues to advance within a framework whose fundamentals remain consistent with higher prices. Beyond fundamentals, recent price behavior also reflects a technical structure that suggests trend continuity. Following a significant advance, the market has not produced a deep reversal, but rather a period of consolidation within a narrower range. This type of configuration is commonly interpreted as a pause before a renewed impulse. This consolidation phase indicates that buying pressure has not been displaced. Instead, the market is absorbing the prior advance and redistributing positions. Selling pressure, while present, has not been sufficient to alter the primary direction. Within this context, the observed technical pattern is consistent with a scenario in which the dominant trend remains intact. Price stabilization after a sharp rise suggests that the market is building a base from which it may continue higher. This behavior reinforces the perception that recent movements do not represent the end of the cycle, but an intermediate stage. Consolidation acts as a process of adjustment, allowing the market to prepare for a potential further advance. Thus, technical analysis does not contradict the previously described fundamentals. On the contrary, both approaches converge on the idea that the current structure favors continuation, even as short-term volatility persists. The silver market is also being influenced by changes in trading conditions in Asia. In particular, the introduction of new volume restrictions at the Shanghai Futures Exchange has altered participant behavior in that region. These limitations have the potential to temporarily reduce activity and generate initial price adjustments in Asian markets. When the ability to transact large volumes is constrained, price formation can become more sensitive to individual orders and shifts in available liquidity. As a consequence, short-term downside movements may occur, not due to a change in fundamentals, but as the market adapts to a new operational framework. However, this same process may encourage the migration of activity toward other financial centers. In this environment, part of the trading flow may return to Western markets, where conditions are not subject to the same constraints. This relocation of liquidity can alter the global balance and exert additional upward pressure on prices. Thus, measures implemented in Shanghai affect not only the regional market, but also the structure of international silver trade. The result is an environment in which tensions between trading hubs contribute to volatility and capital reallocation. Another element influencing recent dynamics is the CME's decision to raise margin requirements. Such adjustments modify the conditions under which participants can hold positions, increasing the capital required to operate. In practical terms, higher margins tend to reduce available leverage and can trigger forced position reductions in the short term. This process typically introduces additional volatility, especially in markets already experiencing strong movement. However, in the case of silver, this tightening has not significantly restrained price advances. Despite the higher cost of participation, interest in the metal has remained elevated. This suggests that underlying demand remains sufficiently strong to absorb these financial constraints. Rather than causing a reversal, the margin increase has primarily contributed to participant reshuffling and intensified short-term fluctuations. In this way, CME intervention integrates into the broader picture as an adjustment factor, not as a force capable of altering the dominant market trend. Beyond futures markets and electronic screens, there's an additional signal reinforcing the current interpretation: the difficulty of acquiring physical silver at prices meaningfully below recent highs. This condition indicates that perceived value among physical buyers already resides at a higher level than that reflected by some reference prices. Limited availability and supply conditions contribute to firm, real acquisition costs. When the physical market shows this type of resistance, it highlights a divergence between financial quotations and the reality of metal procurement. This divergence is often characteristic of phases in which demand exceeds immediate supply capacity. In this context, prices respond not only to expectations, but to concrete constraints on product access. The market therefore begins to reflect real demand pressure more directly. This dynamic reinforces the view that the upward movement is not purely speculative, but supported by tangible conditions in the physical market. The current silver landscape is characterized by a combination of structural strength and elevated volatility. Despite adjustments and short-term instability, the broader trajectory has remained upward. This behavior suggests that the market is operating within a continuation phase of a larger bull cycle. Observed corrections do not alter this framework, but form part of the process by which the market absorbs new information and rebalances positions. In this environment, the $100 level stands as an increasingly relevant reference, even if the path toward it is not linear. Prior movements indicate that significant fluctuations may occur before any additional advance is consolidated. Thus, the present state is not one of exhaustion, but of internal restructuring within an advancing trend. The combination of these forces defines a scenario in which volatility is not an anomaly, but an inherent characteristic of the ongoing revaluation process.